Hey guys, how you doing? It's Will Caban. So Fannie Mae and Freddie Mac, did they just get into the loan shark business? I'm gonna have to say yes, and I'm gonna give you some context of why in a minute. But in order to understand how and why they got into the loan shark business, you have to understand the definition first payment default. If you're in the industry, you probably know what that is. If you're not, basically what that means is on a purchase transaction or a refinance transaction, the first payment is not made. And when a first payment is not made on a loan that is transferred over to a servicer, in essence, the lender has to repurchase that loan back. Now, why is that important? Well, it's important because Fannie Mae and Freddie Mac just announced yesterday that they have defined a way to purchase loans that are in forbearance and meet the first payment default definition. So by sheer consequence, before yesterday, first payment defaulted loans could not they wouldn't be purchased by Fannie Mae and Freddie Mac. But the truth is, this change doesn't really do what we want it to do and need it to do with regards to forbearance, COVID-19, CARES Act, and protections for small businesses, like most non-banks. Now, with context to that, basically what happened is the FHFA had announced that they would be in a position to purchase first payment defaulted loans, but at a huge cost to the servicer. Now, when I say a huge cost to the servicer, there's something called loan level price adjustments. Okay, loan level price adjustments exist for a multitude of different loans. If you have, if you're buying an investment property, if you're buying a condo, if you're buying a property with less than 20% down, if you have a certain credit score, there's loan level price adjustments. And if you Google loan level price adjustments, you'll see it posted right on public website. So these changes added these loan level price adjustments that are insanely ludicrous for non-banks. And just to give you context, the loan level price adjustments for any loans that essentially go into first payment default, okay? And by definition, first payment default could be a loan that goes into forbearance. So you have a client, they close, and a month or two later, when their first payment is due, they're already in forbearance. No payment is being made. By definition, they're in first payment default. Big problem, right? Because before this, the lender had to buy back that loan. So now with this new policy in place, if you want to call it that, Fannie Mae, Freddie Mac can charge up to 500 basis points for first-time home buyer loans, purchase loans, and up to 700 basis points or 7% for all other types of loans. But here's the kicker, okay? The kicker is this is only available, okay, to owner-occupied purchases and rate and term refinances. So there's no cash out, second homes, investment, or multifamily property protection under this program. But this, I want to get back to why the economics of this doesn't make any sense. Okay, and I'm going to show you guys an example right now on the screen. This is from MBS Highway from Barry Habib, Dan Habib, and Megan, and I really appreciate you guys. And here's what this is showing you. Okay, common profit of a company, let's say, is 50 basis points. Okay, on a $300,000 loan, a company might make $1,500. On that $300,000 loan, if they charge 500 basis points for an early payment default, or in this case, 700 basis points, the lender, the company, is essentially on the hook for $21,000 to buy that loan. Okay, it doesn't make any sense. So essentially, lenders would be originating loans for 5 to 6 times the multiple of what it would cost to actually make a profit on that same loan. Okay, so the big problem that exists right now is not just you can't quantify. You don't know who is going to actually go into deferment, right? And if we look at this, the statistics right now, Mark Calabria, who has zero mortgage experience, he's running he's running the entire program for FHFA, and has no mortgage experience whatsoever. A lot of people have called for him to be out. There's been talks that he's been on interviews speaking about 1 to 2% of people are actually going to take advantage of the forbearance, the forbearance option. We're already at 6%. There's projections that we can go as high as 20%. Some people think it might be somewhere closer to 10%. Okay. Every other legislative body is working to help small businesses cushion what's going on in the market with COVID, with people losing their jobs, with income being basically siphoned off, and other aspects of the economy basically just kind of taking a hit. The GSEs, realistically, and the GSEs are Fannie Mae and Freddie Mac, they have access to quite a substantial amount of capital that non-banks, lenders that are either private lenders, direct lenders, brokers, who essentially don't fall under the umbrella of FDIC and are not classified as your normal big bank, don't have access to any of this liquidity, right? So when they passed the CARES Act, Title IV of the CARES Act basically stipulated that the Treasury and the Federal Reserve gave a huge amount of authority to fund facilities and have funding facilities in place to meet short-term financing needs for qualified businesses. Non-banks don't have any access to that. So as a way to kind of tide everything over, Fannie Mae yesterday announced that they would only charge 700 basis points on no cash out, owner occupied, rate and term loans, and 500 basis points on first time home buyer loans, which is basically purchase loans, owner occupied loans. So you can see where the twist and the dynamicism is right there, because of the fact that it's so expensive now to originate a loan when you don't understand or know how or who is going to go into first payment default. So it leaves you with the question of what options really exist, right? And when you start looking at the true options that do exist, there's really maybe two. And when you go into it, you can, as a lender, okay, and to kind of backtrack, this is all going to affect the consumer ultimately. And the reason being is because these two options and solutions, if you want to call it, basically make it more expensive from a pricing standpoint and also from an origination standpoint for non-bank lenders. So the first option is that you can wait to sell the loan and make sure the first payment is made on the mortgage, right? If it's not sold to the GSE, if it's not sold to Fannie Mae or Freddie Mac, they can't go into forbearance. It's not possible because it's not part of the CARES Act at that point, which means that the lender can essentially start the foreclosure process and start, going after their credit. If the payment is made, then they can sell the loan. Now, I want to put context on this, that no lender wants to do that. No lender wants to do that for many reasons. A, because it's not good for the consumer. B, because we don't want to hold the funds on warehouse lines of credit and things like that for a substantial amount of period, because it still costs us a lot of money to do that. And really the third reason is because it becomes a lot more difficult to manage in that perspective. We're not in the real estate industry to own real estate, right? We're in the lending business, and that's what we do. So that's the first option. And I honestly don't think that's a real viable option, but it's an option, right? It's something that if non-banks essentially have to start quantifying what that cost is going to be for these first payment defaults, then this essentially becomes an option that they can execute on. Do I think it's going to be a realistic option? No. But again, if the markets change, profitability dries up, the lenders are going to have to adapt. The second is lenders can charge more per transaction. Now, I'm going to share my screen again, just to give you guys an example, okay, of what this looks like. And again, this is from MBS Highway, Barry Habib. You take that same example, $300,000 loan, company's earning $1,500 on a loan with a first payment default. It's going to cost the company $21,000. So how do you get the $21,000 average out over all the company's loans? If forbearance stays at 10%, right? And they're charging, say, 700 basis points on all of these loans, then average out, it's 70 bips per loan, or you have to raise the interest rate anywhere from an eighth to 25 basis points. So essentially, it makes the loan more expensive. And when you look at it, we just went through the reasons why it would be more expensive. Because either lenders are going to charge more in origination charges, okay? B, they might do both, where they charge higher origination charges and or rates will go up. And if you have that in place, what ends up happening is it's not just going to be one lender. It's going to be the market of non-lenders that will start to take suit and follow suit. So essentially, what we're calling on people to do, especially in the loan market, in the loan industry, in the servicing industry, if you are even in the real estate industry, if you're a realtor, you're an agent, okay, and you work with a lender, and you probably love that lender that you're working with. Why? Because they're not a big bank. Because when you call, they pick up. When you text them at 9 o'clock at night, they answer and they respond, and you probably do some outside business activities with them that's related to getting more business and generating more business. All of that, okay, is going to directly affect non-banks, okay? So when I'm talking about non-banks, I am talking about people who are working for institutions that are not large banks, right? You have, I work for Fairway Mortgage. You have your Calibers, you have your Freedom Mortgages, you have your PRMIs, PRMGs. These are all non-banks, okay? And I know a lot of people that opt to do business with these types of lenders, mainly because the customer experience is a lot better, the business relationship is a lot better, and it overall, it's a better way of doing business for both the consumer and the agent. So essentially what we're asking is that, and I'm going to post some of these links in the description boxes over here, but what we're asking is for people to reach out to our congressmen, congresswomen, and I'm going to post our local congresswomen. If you don't have, if you're in a different state and you're looking at this, there's a link that I'm going to post up also to the National Association of Mortgage Bankers. That is a direct letter. You just put your address in there so that it finds your local representatives, and it will literally send an email to each representative asking for non-banks to be included with part of this relief. So this was just really a public service announcement. I wanted to give you guys a little bit of context in what's going on. And of course, I am not the expert, right? I follow the experts. So Barry Habib, Dan Habib, Dave Stevens, Brian Stevens, these guys know what they're talking about, and I follow them religiously. So I wanted to thank you guys for watching, and I know this is a little bit long-winded. I wanted to be a little bit shorter, but it is what it is. At the end of the day, if you guys have any questions about anything, you can always feel free to reach out to me, but please take action, follow the links. All it's going to do, it takes literally 2 minutes, if that, 2 minutes, to just send the email out to the representatives. Already done for you. Everything is ready to go. All you have to do is put your address, find your local representatives, you click send, and that's it. All right, guys. Will Caban, take care.